Hi, in this video we're briefly going to cover how to calculate the expected return of a stock if we have the beta and we have the expected return of the market and we have the riskless rate. So basically we're just implementing the capital asset pricing model. So the capital asset pricing model builds on the idea that a stock will react or will move in a magnitude which is with respect to the market portfolio that is defined by its beta. What does this mean? In other words, if the market is moving up by 1 point and a stock has a beta of 1, then we can expect the security to move up by 1 point as well. If the security has a beta of 2, if the market moves up by 1 point, then the security is expected to move up by 2 points. If the beta of the security is 0.5, if the market moves up by 1 point, then the security is expected to move down by, if it moves up by 1 point, it's expected to move up by 0.5 points. So basically we are building on this relationship between the market and the securities. Of course, there is idiosyncratic risk, or in other words, there is for each security, when the model predicts that if the market moves up by 1 point, there you have a stock that has a beta of 1.5, your security will move up by 1.5 points, there will be some error, or there will be some idiosyncratic volatility in this. However, if the stock is moving further up than what the model predicts, or further down than what the model predicts because of some particularity of this specific security, then we can diversify these fluctuations by diversifying, or in other words, making a portfolio with similar stocks so that we diversify this stock-specific risk by pulling together stock with similar characteristics in a portfolio. So if you would like, you can watch other videos that will provide more detail about the capital asset pricing model and beta, but for now we're just going to solve a couple of exercises to refresh how to calculate the expected return. So the CAPM, we can just define this, and we can define the expected return of a security in the following way. Expected return of a security is just defined as first the riskless asset rate, or the risk-free rate, and then we add this to the beta multiplied by the expected return of the market minus the riskless rate. So in other words, this term over here, we can call it market risk premium. Market risk premium, in other words, you can think about market risk premium in the following way. You're given the option of investing in either treasuries or stocks. So there is a risk because you have a stock that has the risk of having losses, and you share the losses of the firm if you own a stock, whereas treasuries, you have a fixed commitment that is guaranteed, right? So you're given these two options, and just imagine that these two investments will provide the exact same return. So let's just assume for 1 second that the treasuries are providing a 2% return and the stock that you're being offered is also providing a 2%. Then nobody would invest in the stock, because if you invest in treasuries, you would have a riskless return. Whereas if you invest in the stock, you are having risk and you're not being compensated for it. So then the market in overall, or investors in overall, will require a premium. And let's historically this premium has been nearly 5%, 6%, and this is the premium so that they can invest in stocks and not invest in the riskless treasuries. So then you need to be compensated in 4, 5%, let's assume it's at 5%. So if you want to invest, if a company wants investors to buy their stock, they will need to offer some premium on top of the riskless asset. And then this premium will be higher or lower according to the beta. And the beta, we have it here. So let's assume that we have this firm which is called Silver, and Silver has a beta of, so this is a firm, we're not talking about commodity, is a beta of 1.5. And then we have gold, which will have a beta, gold firm, of 1. So it becomes straightforward to solve what is the expected return of silver firm and gold firm, because we already have the beta. Now we just need to look for the data or look for a historical source of the market risk premium, the relevant market risk premium that we should use, and we are going to assume that it is 5%. And 5% is pretty, it's a pretty plausible value for market risk premium. Now let's assume that the risk-free rate is 4%, just for the purposes of this exercise. Now 4% is clearly not a plausible value right now, but it will fluctuate, and for the purposes of this exercise, we will use the 4%. So silver firm, this is very straightforward. We just need to calculate the 4%, which is RF, and then we calculate the beta times the market risk premium. We can do the same thing for gold firm, so we will have the 4% plus 1 times the market risk premium. So in other words, we will have here that gold firm will need or will have an expected rate of return, or in other words, the investors will require gold firm a return of at least 9%. If they are not getting this 9%, then this investment doesn't make sense, right? And then we're going to assume that here we have this silver firm. So silver firm, in other words, will have this 7.5 plus it will have an 11.5% expected return. So in other words, silver firm investors will require this 11.5% in order to invest in this firm, and if they cannot achieve this value, then the investment will not make sense. So in other words, what is the expected return on the market portfolio? That is interesting. So this is the case. Basically, the market portfolio is just, let's assume that an investor is going to invest in the S&P 500, right? And we can use that as a proxy for market portfolio. Now, what is the expected return on the market portfolio? We know what is the expected return for these two firms, but we do not know the expected return for the market portfolio. So the market and gold firm will move just alike. So we just need to account for the risk-free rate and the market risk premium, and that is the expected return of the market. Gold firm having a beta of 1 is just telling us that the gold firm moves just in a very similar pattern with the market. Whatever is, there will be a volatility in excess of the predicted volatility by the model, and this volatility can be diversified by building a portfolio. So the expected return of the market it will be equal to the expected return of this gold firm, right? Gold firm, because the beta is 1. Okay. In the hypothetical case that there is a security with a beta equals 0, then the expected return of this particular security will simply be the riskless rate. Why? Because when we multiply 0 by this term just cancels out completely, and we are left off with the riskless rate. So if beta is 0, the expected rate of return is just riskless rate. If beta is 1, the expected rate of return of this firm is simply the same as the expected return on the market. And if beta is anywhere, it has a different value. It's 1.5, it's 2, it's 0.5, then we can calculate the expected return of this firm just by using this simple formula. So this is actually not complex. It is actually implementing this model. If we are given these values in this way, it's actually very straightforward. I hope this is useful. Thank you for your attention.